Okay, wonderful. So we are now live and it's recording as well. So we are officially on and I have Tim with me. How are you today, Tim?
I'm doing great, Whitney. How are you?
I'm very good. Thank you.
Awesome.
We still have about a minute until we get started, so I'll introduce you then. And like I said, just wait a couple minutes to see who will join us. And we'll start promptly at 12.
Awesome.
Okay, while we're waiting, what's your highlight? What are you most excited about for the summer?
Oh, for the summer, getting outside and doing things.
Yes.
After spending all winter being kind of cooped up a little bit, and then and then all the stuff going on with COVID-19, it's just nice to get outside.
I know it kind of drives me a little crazy, getting stir crazy. Yeah, I bought a kayak, an inflatable kayak.
Nice.
So I've brought my daughter out once, and then we're gonna go several more times this summer. So
that's awesome.
Yeah. Okay, so it's 12 o'clock and we're gonna get started. So welcome everyone. I'm Whitney Emanuel with Strategic Visionaries, and I have Tim Nichols with Franklin Templeton. Thank you for joining me today, Tim.
Absolutely. Thank you for having me.
Absolutely. So today what we'll be doing is I'm going to have Tim take the reins, and he's going to be talking to us just about the market, has been happening really this first half of the year in light of the coronavirus and market volatility, and then also looking at just how do we act in these market conditions and giving us advice on that. And so Tim, he is Senior Advisor Consultant and he's Vice President over at Franklin Templeton Distributors. So Franklin Templeton is a mutual fund company and an investment company that I told you this, Tim. I get your weekly updates, and they are the most valuable updates that I receive from any wholesaler. So very informative, straight to the point. I never have to really guess what you're trying to get at. And so that's why I wanted to have you join me today.
Awesome. Thank you.
Of course. So it looks like we've got 4 people already who have hopped on. So I'm going to go ahead and have you just get started with the presentation. And then after he gets started, or even now, if anyone has any questions, I will be fielding those questions as Tim presents. And when he's presenting, I may ask questions that I think you may have, or if you have a question, I can see your questions here popping up on the comments screen. So you're welcome to ask questions as we go. So go ahead, Tim, take the reins.
Awesome. Let me get the screen sharing going here.
Go ahead, and then I'll get it. All right. Okay. We're all set.
Perfect. All right. Thank you again for having me, and welcome everybody. And thank you for taking time out of your day to come and listen a little bit, and hopefully ask some questions and have a nice discussion about what's going on out there in the markets and what we're experiencing in this new coronavirus world that we're living in. So let's get going with the presentation. It's titled "Uncharted Waters: Navigating Stock Market Volatility in a Coronavirus World." And our agenda today and what we're looking to cover is we're looking at the current shocks that we're experiencing in the markets and putting that in a historical perspective. We're also going to talk about what's going on in our heads, a little bit of that behavioral finance, what we're going through emotionally and mentally. And then we'll finish up by talking about living with market volatility, some key tips and some things that you can do to help get this through the market volatility. So without further ado, let's go into the presentation part here with just start off with what's happening in the markets. With all the events in the news and the related market volatility, investors may be wondering, how are these events impacting my investments? What is going on? So if we look at this chart right here, this is just showing us the last 10 years of the S&P 500, the cumulative return. And you can see a $10,000 investment 10 years ago has now grown to over $30,000, even with the most recent bear market that we experienced back in March. So if you look at it overall, about a 13.15% return over the last 10 years, a little bit higher than the normal long-term average, but nonetheless, it is a it's been a fantastic market, and overall it's been a really great 10 years. So more importantly, let's look at today and what we've got, what we're experiencing today, and kind of get up close on that. And what we want to look at in particular is, when did this all start and what's going on in the last 5 months or so. Back in December 31st, at the end of last year, coronavirus was first reported back in Wuhan, China, and so we had that first came up, but we really didn't know what to make of it and how far and that would end up taking us and what would happen. So January 30th, just a month later, the World Health Organization declared an international public health emergency as they started seeing cases all of a sudden outside of China. Not even a month later, really just a little over three and a half weeks later, coronavirus fears send the U.S. stocks tumbling, the steepest point decline we've had since December of 2018. And all of a sudden, within a couple of weeks, we are in bear market territory for both the Dow Jones Industrial Average and the S&P 500. And we have a full-fledged pandemic on our hands. Go forward a couple of days, the Fed announced support measures for the markets, right? $2 billion from the United Nations, $2 trillion from the Fed in terms of stimulus package, and an additional $4 trillion in quantitative easing. And we can talk a little bit more about that later in terms of the impact of the markets and what's happening there. But a lot of different things happening. And that was really the start of the rebound of the markets. April 16th, we had guidelines for state opening, and even moving towards the end of April, a number of confirmed cases in the U.S. rose above 1 million. And we also have jobless claims reaching an all-time high. May 13th, the United Nations forecast that the world economy will shrink by 3.2% this year. So a substantial amount coming from the United Nations. House passed another $3 trillion coronavirus relief package. And here we are at the end of May, restrictions being eased in many countries. And then, of course, we have the U.S. protests against police brutality, sparks fears of new outbreaks of COVID-19. So a lot happening in just 5 months time frame, and really a lot to process and a lot to go on. And, the markets have still managed to rebound and do extremely well so far year to date.
I have a question. I have a lot of questions from clients specifically about the most recent activity in the market that's been happening, Tim. So one thing I've heard about this most recent correction is that it was like a natural disaster reaction about the market, and that's how pandemics act. Can you speak to that a little bit?
Yeah. So in terms of the market certainly had the reaction that they did on COVID-19, primarily because there's so much uncertainty around that, and we had not experienced a pandemic really since the Spanish flu back in 1960, 1919 timeframe. So I think there was so much uncertainty with that there was an instant panic in the market, and we'll get into it in a little bit here, some of the different things that have happened out there in terms of other SARS, the swine flu, some of those kind of things. And everything, and they weren't nearly as significant as COVID-19. It did not turn into a pandemic.
Okay, got it. I have another question. So another question that a lot of my clients ask me are, how is the market recovering so quickly when we're mid-pandemic and unemployment is so high? That may have been reflected a little bit, with the most recent market correction, and maybe it was actually giving us real information. But can you talk about that? Yeah,
in terms of the stock market, in my career, you hear the phrase a lot. The markets will climb the wall of worry, right? And there's a lot of worry out there. There's worry about COVID-19. There's worry about the protests, and there had been some rioting and looting and different things. And so there's a lot of things going on out there overall that were really painful, but the markets look at something completely different, right? It's kind of that story between Wall Street and Main Street. And Wall Street is looking at something different, and they're saying that there are companies out there, great companies that are innovating through this process and will innovate going out through the other end of the COVID-19 scenario, and are going to continue to do really well. Take for example a company like Zoom. Who would have thought that we needed Zoom in our lives prior to all this happening? So there are these companies that are creating and doing well, and that's really the kind of stuff that's driving the markets right now.
Got it. Okay, thank you.
Absolutely. Let's take a look at the first part of the agenda here of talking about the current shocks that we're seeing and look at it from a historical perspective. And the first thing we're going to look at, this is a 50-year chart showing you 5 different bear markets. And we're defining a bear market, right, as a 20% decline of the market from a recent peak. And so the bull market starts when the previous contraction has reached its maximum drawdown and continues out until another 20% decline or more. So that's what we're seeing here. So you're seeing bear markets. We've had 5 of them in the last 50 years. And what you're seeing in between these bear markets, though, are some substantial bull markets, right? Mm-hmm. You're seeing 800+% returns in a couple of them. The most recent one we had over 500% return in almost 11 years of a bull market. So you're seeing some really great long stretches of bull markets. If you look at it, as a matter of fact, from just what the averages look like, the average bull market goes on for 7+ years and grows about 402%, while the average bear market is 13 months and goes down about an average of 42%. So a significant difference between these two, between the bulls and the bears. Although I can tell you that the bear side of it feels a lot more painful, right? You feel that pain a lot, and we'll get into a little bit of that in the motions in just a minute, and talk a little bit about why we're feeling this pain so much. So what we do know about market declines, whether we're talking about official bear markets or not, we do know that market declines are part of investing, right? Market corrections, if you will, of 5% or more about every 10 months. We had one last August. Mm-hmm. And then you look at market correction of 10% or more. Every couple of years, we get one of those. December of 2018. And 15% or more, usually about every 4 years. That one actually also happened to be December of 2018. And then the bear market we have, which happens about every 8 years or so, March of 2020. So, these declines do happen, right? We have experienced them before, and some of them happen more frequently, right? The smaller ones. But just keep that in mind that you are going to see declines in investing. That's really kind of the way it goes. Mm-hmm. Let's talk a little bit about how the markets have rebounded from smaller viral epidemics in the past. Take a look at what's going on here with COVID-19. So the first one that we're going to look at is the SARS epidemic that happened in March of 2003. Only about 8,000 people infected, and it was brought to an end by good hygiene and environmental factors like warming temperatures. It burnt out when enough people became infected to build an immunity to the disease. And so big news at the time, certainly not as widespread or significant as COVID-19, but it was definitely big in 2003. 2009, we had the swine flu. And then if you look at 2014, we had Ebola in West Africa. And that ended with human intervention when the World Health Organization declared a coordinated international response. And you had all these countries from around the globe that worked together to administer to the sick. And even when there was a second outbreak in 2018, the treatments that they had developed from back in 2014 helped put that in and keep it confined and take care of that outbreak as well. And then who can forget, in 2016 we had the Zika virus, and then that brings us to today. And we're certainly, this is unprecedented stuff. This is really something different. There's nothing like this in our recent past, and we understand the difference and everything. Keep in mind, as I mentioned before, what the markets really react on, and you can already see that from the steep decline that we had to where it's gone up right now already, pretty substantial. We may revisit some of that and may drop down again a little bit, but But overall, we've been responding pretty well to COVID-19. At least the markets have, and we think that is likely to play out over a longer period of time in a positive way.
Yeah, I know a lot of my clients ask me about a second wave, and if they should anticipate some market correction with the second wave with the coronavirus.
Yeah, that is something that we are definitely considering as well. And for us, there are two different things going on. Number one, a second wave of COVID-19, but that certainly is going to have an effect on the market and the health implications that has. What that will also do, we're afraid of, is what that's going to do to the consumer. And the consumer is already significantly damaged. When you think about the fact that that 75% of our population lives paycheck to paycheck, then you're looking at a situation where a lot of people are struggling with this right now and can continue to struggle. With the unemployment numbers we have, there's a lot of what we would refer to as demand shock, right?
Yeah.
That people are saving more money, not spending as much, and so the demand's not there. So that could definitely, if we get a second outbreak in the fall, I know that's kind of more the time frame people have been talking about. If we get a second outbreak and that does further damage to the consumer, then absolutely we could see a pull in the market.
Yeah, because spending continues to go down is really that key factor, would you say?
Absolutely. Yep, absolutely.
Got it.
And the other thing on that, the last thing I'll say on that end before we move on is that coming into this year, if you were to look at the U.S. economy overall, 70% of what was driving the economy was consumer driven. Right, the consumer was responsible for that much of the overall economy, and so when you have a damaged consumer, you're going to have a damaged economy, and the markets will probably end up following suit if that happens this fall.
Okay, got it.
So let's talk for a minute about what's going on in our heads, right? And at the end of the day, we're all emotional beings, and when volatility strikes, many of us feel like we're riding a roller coaster. So let's find out a little bit about what's going on in our heads. The first thing is, when you think about the human brain, right, we've got the frontal cortex, which processes lots of information and makes logical and informed decisions for us. And that's the part that we do a lot of our thinking about, right? What clothes to wear, what to eat, how to drive to work, if you happen to be driving to work right now. And then the other part of the brain, a small little part of the brain, is the amygdala. Right, and that's often referred to as your reflexive brain, the part of your brain that connects different stimuli that's going on around the world, and really and allows you to make these reflexive decisions, oftentimes based on emotions. The example we're going to use is kind of old school, right? We're going to talk about a caveman, and if you think about the amygdala when confronted with the saber-toothed tiger, that being the stimulus, that caveman's probably going to run based on past experiences, right? So that's the fight or flight response that we have. But if you let your reflexive brain really control your reactions when it comes to making financial decisions, you can really lead yourself into some undesirable outcomes. And we'll talk a little bit more about those as well. One of the emotions that we do see out there from a behavioral standpoint is anchoring. And this happens quite often where people will anchor their thoughts based on just one piece of information, one set of market returns. And if you take a look at, during a survey that we did, we asked investors, what is your expectations over the next 5 years for your portfolio? And the median response out there was 10%. But when we presented them with a 20% hypothetical, guess what? They shifted their expectations to 20%, right?
Yeah.
They all of a sudden are like, yeah, my expectations are that I'm going to have 20% per year. And interestingly enough, after we introduced that 20% hypothetical return, we told them, okay, now the next year the market's going to be down 20%. And what they came back and said, well, then my portfolio would probably only be up 3%. They thought they would outperform the market by 20%. Because they were coming off that 20% anchor. So, and I can give you an example on this next slide. if we take a look, this is just looking at the S&P 500 versus an 8% average return over the last 30 years. Now, in a perfect world, I guess you could plan and say, well, I want 8% per year, and if I got a nice even performance over that entire time frame, that would grow to a little over $100,000. But that's not the way the markets work, right? So the markets, when we look at them, they're going to perform more like that. You're going to see some ups and downs.
Sure.
And I remember back in when I was covering, working in a similar role back in the late 90s, and all of a sudden the market returns were 20-25% per year after year. Alan Greenspan with his irrational exuberance comment, those kind of things. People thought things were going to go to the moon at that point, and
right.
You had people, and I knew people at that time that quit their jobs so they could sit at home and day trade.
Wow.
And it was just, they thought it was just that easy. Why would I go work when I can trade some stocks in the morning, play golf in the afternoon, and everything? And then what happened is you have the tech wreck, right? And that's where people get a little bit, like, okay, this isn't as easy as I thought. Ultimately, if you were to stick through all of the ups and downs of the market over the last 30 years, you certainly got more than that 8% return, and
sure.
Your $10,000 grew to $172,000. So
right. I have a question. Maybe you could speak to this now. Sarah asked, should I stay invested right now or be in cash?
Yeah, and that's a great question, and the one that you work, that's why you work with an advisor like Whitney, and
right.
there's so many things that depend on your personal situation. And the thing that I always worry about when and there's a chart that I'm going to show up here in a few minutes, that you can't really time the market, and I'll give you an example, a couple of examples of that, but timing the market is really impossible. And if you could have told me to get out of the market back in early February and then get back in April 1st, I would have done exceptionally well. I would have a lot more money, but nobody knew everything, and that's because nobody knows how these things are going to play out.
Right.
So I would be really reluctant to tell somebody to get out of the markets right now and go to cash. That it just never works out well.
Right. And I can speak to that a little bit too. It depends on your timeline as to when you need the money. But if you're drawing income from your investments, you want to have at least a year's worth of expenses in cash, right? So that way you don't have to withdraw from a portfolio that's losing. So you have that cash buffer. But if you have a really long time frame and you're 20, 30 years out from retirement, the only cash that you really need to have are for your short-term goals and in your emergency fund, but everything else should just remain invested and having, like Tim said, that long-term view rather than short-term view.
Yeah, absolutely. And to your point, you mentioned your time frame and everything, and then there's risk tolerance and those other things. And there are ways to stay invested while being maybe a little more conservative about it, but ultimately, focusing on that long term and those long term goals is definitely the key to staying in there.
Right.
And let's talk next about loss aversion, because that leads really right into what we're here, is that the pain we associate with a loss is much more intense than the reward felt from a gain. And scientists have actually proven that it's twice as much, that the pain is twice as bad versus the reward that we get from a gain. People just don't like to lose, right? That's just the bottom line. They just don't like to lose. And so what happens, though, when we do get these bear markets is that fear will drive investors into cash. Back during the dot-com bust, we saw almost $500 billion move out of investments and into cash. So it was huge. And then if you take a look at the global financial crisis, back 2007 through 2009, we saw $943 billion. And here's one that we don't have on the chart, but it's worth noting. Back in the month of March alone this year, we saw $250+ billion in just 1 month left investments and went to cash.
Yeah, it was such a short, condensed period of time for that much money to leave the market.
and everything was flooding out and everything. And here's a question I always ask anybody on the line and everything. Just imagine in your head, because I don't know the exact number, but I would like to know how much of that $250 billion got back in by April 1st, right? Because the month of April this year, we had the best 1 month return of the stock market since 1987.
Yeah.
So, 33 years between these great months. And so I just don't think that much money came back in and got back in.
Do you think it's the Fed?
Yeah, it's a little bit of that, but I think there was so much fear out there that people were just so scared they just wouldn't move back in.
Yeah.
And speaking of the Fed, take a look at this chart. This is the market yield right now. And when you think about where rates are today, this isn't moving anytime soon, right? Money market yields are going to be really miserable as we move forward. And when you start looking at it from an after inflation basis, you're actually losing purchasing power by sitting in money market, sitting in cash. Now, it doesn't mean, right, that you shouldn't have some money set aside in cash or savings or money markets or whatever. That's not what we're saying at all. But when you think about your long-term focus and your long-term money, maybe not the best idea. Right.
It doesn't keep pace with inflation. That's why I always tell clients, that's why you don't want to have too much in cash, no matter how conservative you are.
Exactly. So let's take a look. The third part here we're talking about living with market volatility, right? And just different things that you can do to live with the market volatility. The first thing we would say is stay calm, right? Just stay calm, keep that long-term focus, long-term perspective, and really just kind of sit back and relax a little bit. By taking the long-term perspective, let's take a look at this chart right here. We're going back to our 50-year chart of the S&P 500. I'm going to throw back in these the bear markets, and we're going to take a look at some of the names behind them. I happen to be, I was in college during Black Monday in 1987, but I was in the business for the tech bubble burst, global financial crisis, COVID-19. I should mention I was a much younger version of myself back in the energy crisis, a little kid at that point. But these are the bear markets that we were talking about and sharing earlier. But if you would have invested $10,000 in the market back in December 31st of 1970, and you were looking at your statement here at the end of May, it would now be worth $1.4 million. And you would have had an average annual return of over 10.5%. So
is this why people does that speak to why people like market indexes so much?
Yeah, well, exactly. And you look at the long-term perspective here, right? And you look at all the different names of everything that's gone on. They're painful, right? Every single one of these is a painful event for people. Right, that's invested. But this is why people like to stay in the markets and get in the markets and keep that long-term and just keep plowing through these, through these different bear markets. So one of the things that we kind of coach people on is to tune out the noise. There's a lot of noise out there, right? A lot of noise about a lot of different things. You look at there's no end to the amount of market information that you can get your hands on. It's everywhere. The question I always ask is, how often do you currently look at your portfolio? And how often are you keeping an eye on that? And the reason why is if you look at what's going on out there, you want to tune out the noise, because on a daily basis, if you're looking at your account every single day, watching the markets every single day, you're going to be disappointed almost half of the time. Right.
And Pam commented, she said, and this, to your point, the media is not really reporting on the good stuff. So she says, what role does the media play as far as influencing behavioral finance? So, consumer behavior in the market.
There's no doubt that they definitely they're playing off the fear card, right? They're looking at the things like the loss aversion, because they know that the aversion is painful. They know
Right.
that how people feel about that. So when the losses hit, they're going to highlight that, and they're going to hammer that point home. That's basically what sells advertising for them, right?
Right.
People tune in to like, oh my gosh, what's going on? And when the markets are going up, it's not that people don't watch when the markets go up. They do, but maybe not quite as intensely. They're not quite as focused on the markets at that point.
Yeah. So they're more focusing on it's just drawing attention to what they're already worried about.
Exactly.
Do you think that do you think that maybe media influenced like the mass exodus from the market due to the coronavirus?
Yeah, I mean, definitely that. I mean, I think they were definitely tying that all in together. Now, some of the, depending on how you're looking at the media and talking about the media, like some of the comments I'm making about the loss aversion stuff, those have to do with more like the CNBC type shows.
Yeah.
And kind of things, versus the general, what I would call, I guess, the general media out there. But yeah, there's definitely a big tie-in for those two things. The COVID-19 and the markets for sure.
Yep. Okay.
But even though COVID-19 is still out there and gaining in some states, the market is now somehow ignoring what's going on.
Right.
Who knows, right? So if you take a look at the next thing we're going to talk about is just diversification, right? And we think diversification is really important. It might be really tempting from time to time to say, I'm going to put all my money in large cap growth stocks, or I'm going to put all my money in emerging market stocks. But we really take an approach that says diversification is something really important. And if you take a look at this chart, it's a very busy chart. But quite simply, each column up and down is just basically a year, 2005 out to 2019, the best performing parts of the market at the very top, the worst on the bottom. And so there's a lot happening in this, but we're going to pull out and take a look at the emerging market stocks. And if you look at the emerging market stocks, what you see is you're going to have a number of years in the last 15 years where they're on top. They're the top performing asset. But you also have some years in there where they're the bottom performing asset. Okay, so you've got the good and bad of emerging stocks, emerging market stocks. And so if you were to take a look at that, and you're imagining it after one of the years where it's done really, really well, I'm just going to chase the winners. If that was your attitude, right? I'm just going to invest in last year's best performing asset class because I think it's going to continue to do great. It did not do poorly over this time frame, right? 6.99% return for chasing the best one. Let's say on the other hand, you want to invest with the losers. You're sitting there thinking, you know what, that loser is going to come back.
Yeah.
It's going to rebound. You're kind of more of that contrarian mean reversion kind of investor. Not bad, 6.56%. But if you had remained allocated across all of the asset classes, your return over that same time frame, 7.57%. So, for us, when we talk about it, it's like, don't get caught up too much on what's going on with this sector is doing so well right now, or this part of the market and everything. Those things tend to come and go.
Yeah, definitely. And I think that's good too, that this is a timeline between 2000 and 2019, because it's like not the old market, it's the new market. How the 90s and 80s was totally different growth trajectory. So this is current, what we have gotten with returns for the last 2 decades. So I think that's really
helpful. Yeah, absolutely. And keep in mind, as well, in this way, you're looking at longer term time frame. When I started the presentation off with the last 10 years of 13+% return for the S&P over 10 years, the prior 10 years, right? If we go back to the 2000 through the end of 2009, the S&P was actually slightly negative for that 10-year time frame.
Right,
so,
exactly.
Yeah, just one more reason why, when you look at it, just, if you keep a nice, balanced, diversified approach, can make a lot of sense.
I have a question from Pam. She says, if we're going to occasionally check in on market trends, what's the best resource?
Well, that's, I usually, and I, you might have some things that you prefer, Whitney, on this, but I usually go to CNBC.com just to get market information and take a look at what's going on out there. But maybe you can some of your favorite spots.
I like Wall Street Journal. It's really good, and I like also BBC. They do, more international, and they do have some commentary on the market. So I think that's helpful because they don't just look at it from a U.S. perspective. But for just specifically U.S. markets, I like the Wall Street Journal.
Yeah, awesome. Yeah, there's some really good resources out there. One of the things I don't necessarily, it's interesting to see him sometime, but Kramer is one that people will ask about.
Yeah.
And Kramer gets a little wild on his shows and everything. And when you actually read Kramer's books and everything, it's different than the personality that he has on the TV, right? On the TV,
Right.
He's selling advertising basically. Yeah, there's, not necessarily my favorite source, but entertaining, that's for sure.
Yes.
So one of the things we do talk about is we talk about remembering your strategy, right? It may be tempting to pull out of the stock market during volatility. To the question earlier that was asked, about pulling out of the markets and going to cash. But we think it's really important to stick with that investment strategy and that long-term focus. If you take a look at this chart here, what we're looking at is we're looking at a year over year going back to 1988, and the green bars, what they're representing is what the performance was for the market for that entire calendar year. So you can see that as you go back through the last 30 plus years, there were 6 years where we had negative returns in the markets. We had 3 in a row, 2000, 01, and 02. But the green bars represent that total return, and the blue section there, that's what we would refer to as the match drawdown, right? And that would be the market, the highest amount of negative returns, right? Where the market got the lowest during that year. And you can see there are a lot of years where you had downturns of the market of 5, 6, 7%. That happened quite often. And remember the chart we discussed earlier, right? A 5% correction of the market happens about every 10 months. So this really makes sense for those situations. And then you have some others that are into the double digits, from 11 up to 20, and then a few that are definitely more than that. And so the point is that staying invested and not letting some of these downturns really bother you and make you want to pull your money out, because the blue bars are going to happen every single year, right? There's not a single year out here where there's not some sort of drawdown on your portfolio.
And it's, Pam says asset allocation is boring, but it works. True. And so what I'll do with clients is I have majority of their assets, but then maybe they want to play and they're not thinking they're going to win everything, but then they'll have a play account over, at Vanguard or something that I don't manage. But having a majority of your assets have, a very planned and strategic asset allocation plan, and diversification is wise, but I understand that urge to have some fun. So it's having that play money on the side, with Robinhood or anything like that is what I'll tell people.
Absolutely. And I'll get asked periodically about different areas. We have one of our sector funds that over the last 12 months is up about 53%. And people are like, what? It's up 53%, but that's the last 12 months. And it's just,
right.
It's one of those areas where it's like, that's not necessarily what's going to happen the next 12 months. And I don't know how to get in and out of those and what the right way to do it. But,
right.
But yeah, to your point, having a little bit of play money on the side to look at some stocks and do something, that absolutely.
Yeah. I have a question from Linda. She says, hi, everyone. Have there been attempts by the Fed? We kind of talked about this a little bit before, Tim, by the Fed or other entities to prop up the market due to COVID? So that's her first question. And what can we anticipate with all the civil unrest? I'll just answer that question and say we don't know. But I do want to talk about, because, we just have no idea. We talked about the unpredictability of the market. We don't know what will happen and if that will affect the market or not, because that's Main Street, I would say, is that civil unrest. It's not Wall Street. However, what about that propping up of the market by the Fed?
Yeah, and you could certainly have a discussion on whether that was intentional or unintentional, but it's certainly popped up the markets. And it wasn't, the key thing to look at here too is that it wasn't just the Federal Reserve here in the U.S. Central banks from around the world did the same, took the same actions and did the same thing. whether you're talking about in Europe, you're talking about Japan, you're talking about a lot of different places going around the globe that were actually doing similar type things that the Federal Reserve is doing, trying to keep, soften the blow, if you will, because
Sure.
we're clearly in a recession. There's no question about that. So if you think about the fact that we're in a recession right now, what they're doing is basically trying to lessen the blow of that, and it has you call it direct or indirect impact. It certainly rallied the markets. There's
Right.
no
Well,
question.
and it allowed them to buy corporate bonds too, which was quite interesting, right? And municipal bonds.
It's incredibly interesting that they came out and doing that, whether it be through the purchase of ETF bond portfolios,
Right.
or other individual corporates. That is definitely unprecedented. We've never seen that from the Fed, and so there are some things that they are really trying to do to stabilize everything and let people know that it's going to be okay. Now, our folks, I will tell you, we're concerned because you can't just keep throwing money at this. At least we don't think we can. How many other trillions of dollars can we pull out and throw at these problems as they pop up? And that is something, honestly, that has us pretty nervous.
Right. Yeah, I agree. And we can't rely on it. Yeah, like you said, it's not sustainable. So we can't rely on that. And I know another one of their strategies was to try to increase consumer spending, right? But that didn't happen. So that backfired a little bit as far as one of their strategies. So that was another thing they were trying to do. Yeah. So
absolutely. I think the month of April, we saw the savings rate out there was over 30%. And when you think about that from a historical standpoint, the average long term is more like 5. And so when you all of a sudden people have concerns about their employment and concerns about their health on top of that,
right.
You're talking about people that are just basically keeping it tight, not spending a lot of money, and that's why, like I said earlier, you really got it's going to take a lot to get the consumer up and running again.
Yeah, I agree. It will. That's why. And again, I think that points again why we're in a recession and why it could last a while until, who knows, maybe until there's an immunization or the virus has gone down significantly. And then Pam asks, do you agree with what the Fed is doing? That's a very subjective question and answer. I guess I'll comment, and then you can too, Tim.
Yeah.
I think I agree with the fact that they were very proactive and they acted immediately. In 2008, there was too much of a delay in their reaction, in my opinion, which caused a lot of the downturn to be extended for so long. So I do agree with their proactivity. Their particular actions, I can't necessarily say whether or not I agree with them. Purchasing bonds has always been a strategy, but now within monetary policy, but I'm not sure that I am liking the fact that they're crossing lines and going into more private bonds and such, because you can't necessarily just fix the problem by throwing money at it. So I'm mixed. I have a mixed response.
Yeah, and clearly the markets loved it, right? The market loved the Fed coming in and doing that, and we just think, yes, the good news, and Whitney, you're absolutely right. They reacted quickly. They got something on the table, and just to kind of hold off any disasters. Now, we would probably argue that they've gone too far. Much to your point about buying bonds and doing different things along those lines. We just think they've done too much, and the thing that nobody enjoys a recession, nobody enjoys a bear market, but you go back through history, those are pretty natural occurrences, and to try to lessen the blow on those, but yeah, we just think they might have done too much, and now there's still talk of them going with negative rates, and negative rates haven't worked anywhere.
Right.
They haven't worked in Europe. They haven't worked in Japan. We just don't. We just think that they're going down the wrong path if they decide to go negative with the rates. They have other tools that they can use, and
Right.
they're using them, right? They're using them. But yeah, going negative rates, we just think that would be a bad idea.
Yeah, I don't like that.
Yeah.
I don't like that strategy. I don't know. We don't know what they'll do, right? So we can't predict that. But we do know that if they do go negative with rates, that would be bad for conservative investors. Very, very bad. So
that'd be bad for the savers, the conservative investors, the people that are living off of income.
right.
Not to mention what that would do to all the financial companies out there, the banks and whatnot.
Right. Yeah.
Just not a in our opinion, not a great plan. And we don't think they're going to do it either, by the way. But
yeah,
there's definitely talk of that. Well, let's take a look. One of the things that we can do and talk about, and for people who do feel stressed and nervous about volatility and what's going on, and they do feel like they got to take a little risk off the table, dollar cost averaging can be an incredibly effective way of actually getting yourself back into the market, right? Because you go in at different prices, and we'll just take a look at a hypothetical example here. 6 months of putting $500 a month in, and you can see in the middle column the share price. You're getting different share prices at each of those months. And the good news is when it's at its cheapest at $8 a share, that's when you buy the most number of shares, right? It's just like buying anything on sale at Target or Cub Foods or wherever it is you happen to go. You get more of that thing when you're getting it on sale like that. So the dollar cost averaging in this scenario works well enough that your average cost is 23 cents lower than the average share price. And you're saving yourself 23 cents. So the dollar cost averaging can really help, I think, calm people down through these difficult times. And when you think about if you are working out there, you're not retired or whatever your situation might be, you got a 403B or 401k or something, you're automatically dollar cost averaging into that plan. And that can make a lot of sense in these volatile markets. Let's talk about, this gets back to a question earlier too about, getting out of the markets, getting into cash and whatnot. If you take a look at the last 20 years of the S&P 500, and you had stayed fully invested the entire 20 years, you end up with a return of almost 6%. Now, if you miss just the 10 best days in the last 20 years, on average, one day every 2 years, you miss that one day every 2 years, you miss the 10 best over the last 20, your return drops by over 4%, 4% per year. And you miss the 20 best days, you're all of a sudden in the negative territory, and the 30 best days, you get even deeper into it. So again, an example, and we'll take a look on this next chart here about, just the timing of the market and how difficult that can be. What we've got on this page, we've got on the left side, we've got the 20 worst trading days in the market over the last 20 years. And on the right-hand side, we got the 20 best trading days. Now you can see from the dates, a lot of these have happened either this year or back in 08, 09. You got one or two during the tech wreck, but a lot have happened in a couple in the bear markets we've seen with the worst days. But guess what? So have some of the best days, right? For example, this year, March 16th, the market's down 12%. The very next day, St. Patrick's Day, the market's up 6%. Next, you go back even just a little bit before that, same basically the week before that, you had 9.5 down on the 12th, up 9.3 the next day, and so on and so on, right? These days happen so quickly. So the thought of trying to time the market and say, well, I'm going to miss this bad day, but get back in and catch the good days, it's just not realistic. It
doesn't work.
It doesn't work. You can't do it. So again, just keep focus on that long-term strategy and not trying to figure out, in and out of the market, trying to time it. It's impossible. So key takeaways from the presentation today. First of all, history has shown us that while the markets react to shocks in the short term, they have tended to reward the patient investors over long periods of time. Our emotions affect decision-making ability in times of market volatility. Our behavioral biases such as anchoring and loss aversion, they can lead to some desirable outcomes. If you let them, get a hold of you, I mean, they can definitely lead to some undesirable outcomes. And then 3 ways to live with market volatility: stay calm, right? Stay calm and keep focus on the long term. Diversification matters, right? It's important.
Mm-hmm.
And remember your strategy. Remember that long-term focus that you have. If you have those concerns and those thoughts, talk to Whitney. Make sure that you're comfortable with everything going on and all. But remember, you set these goals and you set these things up for a reason. Everything and getting too caught up in what's happening today or last week or the last month, it can be really, really difficult to do.
Right. Awesome.
So that's the presentation, Whitney. Thank you so much, and I'm happy to stay on, and then absolutely, we can do some additional Q&A.
Yeah, absolutely. Thank you, Tim. Really appreciate it. It was very informative, just what we were looking for. And of course, I want to just comment on, remember your strategy. If you're viewing and you don't have a strategy, or you're not working with a financial advisor, having a strategy and sticking with it, that's really a part of what can give us peace. So despite the market volatility, so that's why it's so important to have a specific plan in place for your investments, because it's really just achieving your life goals. So, but we're open to any questions. I have a couple thank yous from people who are joining. Yes, of course, you're welcome, Chris, Pam, Linda, Sarah, thank you for joining. Do we have any other final questions before we end? I know we had some throughout the presentation, and Tim and I are here to answer anything else that you may have for us. Thank you, great information. You're welcome, Annette. Good to see you. And I'm hoping this is the first time that I've done this, Tim as well, with this specific software. So we got it all to work. But we're hoping that this is recorded, because I'd like to be able to send it out to clients. So we'll keep you updated on that as well. Sarah and I will. Doesn't look like we have any other questions. That's a good thing. That means that the questions were answered throughout. So any other final comments, Tim?
No, Whitney, thank you so much for the experience and being on here. It was a lot of fun. I really enjoyed it and everything, and hopefully it was beneficial for everybody. So thank you.
Absolutely. Thank you again. And then I have access. Oh, here, Pam does have a question. So this is for me. How do you manage the emotions of your clients when they are less than calm? Great question. So first, actually, there's this quote that I saw that I thought was really good. It says, you can't heal if you keep pretending you're not hurt, right? So first, we have to recognize the emotions and where are they coming from, and are they founded or unfounded fear? And so is it just panic that's media induced based on the situation, or is it because your investments are too risky for your risk tolerance? So really trying to address, where is this fear coming from, and is it an appropriate reaction to the circumstances? So I like to try to explore the fear, and then I think revisiting, going back to what is your goal at the end of the day? Will your current strategy actually meet your goal? And then I'll run it in the financial planning software with the market volatility. Are you any more off track than where you were before? More likely than not, it doesn't really put you much off track, as long as, like what we were saying, stay invested. So, but yeah, I like to really show people the numbers, and showing just a slight fluctuation in the market doesn't really affect your likelihood of success with your goal and with your plan. Chris says, should I take an anti-anxiety pill?
Nice.
If your doctor has already prescribed them, yes. And then Annette has the wine emojis. Yeah, that's a good way to manage anxiety.
I do that too.
Yeah, but like I said, identify what you're feeling first. Where is it coming from? Are you invested according to your risk tolerance? And then are you invested according to your goals? If you can say yes to both of those questions, you should be able to stay the course. And always contact me if you have questions. Or if you know someone who's nervous about the market and they're not getting contacted by their advisor, have them call me and get a second opinion. I'm always happy to talk. Pam says, talk to Dr. Whitney first. That's awesome. All right, well, I think we are ready to wrap up. Thank you again, Tim. And I was just going to say this before we get some questions, is that I have access to Tim. So if there are any specific questions that you have for him post-presentation, just let me know and I'm happy to forward them on to him. He's a resource for me. So thank you again, everyone. I pray you have a wonderful rest of your day and weekend. And please contact me if you have any questions. Send me a message on Facebook, which is where we're on now, or you can send me an email, give me a call. All of that contact information is on my Facebook page or my website. Thank you, Tim.
Thank you very much, Renee.